There's a whole
Hmm.
diverse range of outcomes, but the worst outcomes, which are reasonable, has not been priced in. Normally, when the gold price moves up, the input costs move up. The cost of oil goes up, the commodity currencies, which is your second largest cost input, because that's everything local. We may see a situation where we don't actually get any cuts in interest rates for the next couple of 2 or 3 meetings.
We're back with Adrian Day, president of Adrian Day Asset Management and portfolio manager of the Euro Pacific Gold Fund. Adrian's been on several times in the show. He's a regular on the program. Check out one of our last interviews, linked down below. We're going to talk about risks and opportunities as of April 2026. We're entering the second quarter of the year. A lot has happened and a lot is about to happen. How do we position ourselves? Welcome back, Adrian. Good to see you.
Well, and you, David, thank you for asking me.
Thank you for being back. Adrian, let's start with some systemic risk issues that are on people's minds. Besides inflation potentially spiking through the roof if oil remains high, we have a complete system meltdown potentially in the works. This is an extreme case, but listen to this logic here. Once we have higher inflation expectations from oil, we're going to get a more constrained or restrained Fed. With a more restrained Fed comes tighter monetary conditions, which is going to put stress on the already stressed private credit market. You've no doubt seen headlines about people trying to take investors taking money out of private credit markets, and banks and fund managers are limiting redemptions. And so that system is going to be even more stressed by a tighter Fed. The question is, Adrian, to what extent will higher oil, if it remains higher for much longer, put a financial stress on a system and cause a liquidity crunch?
Yeah, absolutely good point. Because I think it's important to realize that, every aspect, every facet is not isolated. It always has effects on other things. And, you're quite correct. Everybody, you're quite correct. It's been well talked about, but higher oil prices are going to have a meaningful impact on prices, on consumer prices. Um, I would again argue that this is not inflation. Inflation and consumer prices going up are different things. And unless the Fed increases the money supply, then a higher price in one area means a lower price somewhere else. But higher oil prices are definitely going to have a major impact on consumer price index, not only because of obviously gasoline, gas in the tank, but also on everything else, on transportation, of course, but on food in the stores. All the food in the stores is transported from somewhere. And so a higher oil price not only has that immediate impact on the price of gasoline, but it starts to flow through to all sorts of other commodities, all other goods in the CPI. And the Fed is clearly, and other central banks around the world, are clearly focused on those higher prices. And this was clear from Jerome Powell's press conference after the last Fed meeting earlier in March. It's clear from the dot plot, where Fed members are expecting or anticipating just one rate cut this year. And to me, David, even more significantly, only one rate cut next year. And if you read the last minutes, which of course were before the war, the press conference was after the war started, but the bombing started, but the minutes were of the last meeting before the bombing started. Even then, more Fed members were more concerned about the inflation risk than the risk to the economy and employment. And so we're seeing, I think we're definitely seeing a Fed that for now is going to be more restrained. And it's not just the Fed. We've seen Bank of Canada, Bank of England, European Central Bank, Bank of Japan. They've all made comments in varying degrees, suggesting they're not going to cut rates. And in fact, in some cases, may even have to hike rates because of higher oil prices. And you're right, as we get higher oil prices, that leads to high consumer prices, a Fed more tight. More tight means more stress in the system that is in many areas already stressed. We have margin debt at all-time record highs on the stock market, but we have private credit, and real estate, both of which areas are highly dependent on leverage and therefore debt. And so a tighter Fed really will affect those areas. But one other thing, if I may, David, yes, the higher oil price, of course, means higher consumer prices, but it also means that the economy is going to slow. A higher oil price, other things being equal, will lead to a slower economy. And so we've got these two things going on at the same time. And of course, the last big time we had a huge spike in oil and restrictions on supply was the oil embargo back in 1974. And that, of course, led to the deepest recession since the 1930s. As well as a 35% drop in the stock market and a almost 50% drop in gold. So the risk is not just on the inflation side with the economy moving along fine. The risk is the prices move up at the same time that the economy slows.
Right now, we have here a situation where a jobs report just came out today. And let me just read part of this article here. U.S. Treasury yields rise after strong jobs report. U.S. Treasury yields jumped on Friday following data that revealed the economy added significantly more jobs than anticipated last month. Benchmark 10-year yield increased 4.7 basis points to 4.36% after the employment figures were released. The stronger than expected job creation has reduced the likelihood of near-term. I know that payroll numbers are noisy. They change month to month. But if you were to evaluate the general trend of the labor market and furthermore, the general trend of the bond market, we'll talk about both in just a minute, starting with the labor market, what would you say is the momentum right now?
It's difficult to say because, as you say, I certainly don't think the labor market is anywhere near as strong as the headline numbers suggest. Today's headline was obviously positive. But it's certainly true if you look at the last 3 to 6 months, it's certainly true. But if you look beyond the headline number, you see a market that is not as strong as it appears. First of all, as you said, these things are subject to revisions. And over the last 2 years, something like 9 out of 10 first and second revisions. So you get the number, then you get the first, and then you get the second revision. And over the last 18 months, 9 out of 10, literally 9 out of 10 of those first or second revisions have been downwards. So first of all, I would not be at all surprised if we see these numbers revised downwards. That would be par for the course. The second thing is we have these huge annual revisions, 1 million jobs, 1.2 million, 800,000 jobs that, well, we said they were created, but they weren't. So that's the first thing. The second thing, David, is I haven't had a chance to really dig into this particular payroll report. I apologize.
That's
But
okay.
if you look at the previous payroll reports for the last 12 months, there have been zero, and I mean literally zero, net creation of full-time private sector jobs. And without full-time private sector jobs, I don't think it's a healthy economy. We can argue about government jobs, how valuable or useful they are. I have my own opinions on that. But certainly with part-time jobs, a lot of people are getting part-time jobs, not because they want to stay home with the kids half the time, but because they can't find a full-time job that's suitable. So people are working 1 or 2 part-time jobs. That's not a healthy economy. It's not a healthy labor market, I don't
Why
think.
would yields rise on a hotter than expected payroll report? Is it rising because yields typically rise, and I'm talking about the long end of the curve, like the 10-year and 30-year, they typically rise when expectations for a stronger economy hit the market?
Well, in this particular case, I think the stronger payroll means that the Fed, with the inflation that we're talking about, it means the Fed probably won't cut rates. If it was a weaker payroll,
So
then the
we've
market
got
will be looking.
Nobody talks about the cost of being right too late. Not the cost of being wrong, the cost of being right. Seeing something coming, understanding exactly why it was going to happen, and then watching it happen without you. Well, gold has gone from $3,000, then to $4,000, then to $5,000 in a very short amount of time. And a lot of people watching this right now knew that this was coming. They felt it in their gut. They understood the deficit spending, the central bank buying, the writing on the wall, but their retirement account never reflected any of it. That is the gap we need to close today. JP Morgan is projecting $6,300 gold price this year. Central banks are not pausing their gold buying, and the people who look back without regret will not be the ones who were the most informed. They will be the ones who actually did something about it. My friends and sponsors at Priority Gold created a free precious metals playbook that shows you exactly how to add physical gold or silver to your IRA or 401k tax and penalty free. They handle everything. You just have to take the first step. So call 866-407-6456. That's 866-407-6456, or take out your phone and text David, D-A-V-I-D, to 24999. You can also scan the QR code here on your screen or click the link in the description down below. Again, 866-407-6456, or text DAVID to 24999. We've got the 10-year at 4.3%. I understand what you're saying. Yeah, the Fed probably the bond market's reacting to a more hawkish Fed potentially. Where do you see the long end of the curve going? Because that affects precious metals. Well, it affects all markets, but we'll talk about precious metals next.
Markets, yeah. Look, I'm not a bond expert, David, and I've learned not to pontificate on things
All right.
that I don't know too much about. But I mean, at the short end, I'll come to the long end in a minute, but at the short end, the Fed might try to resist cutting rates in the near term. But I think if you put a combination of the weakening economy coming from the higher oil price, but also the stresses to the credit markets that you were talking about, that means that means the Fed is going to have to, or will, not going to have to, but they will inject liquidity into the system to prevent major bankruptcies from whether it's banks or big investment firms. And so we may see a situation where we don't actually get any cuts in interest rates for the next couple of 2 or 3 meetings, but in fact the not QE that they started in December, the 40 billion a month until April, we might get a situation where that's extended, or perhaps it stops and then comes back after we see major stress with some of these private equity firms. And there's no question that there is significant stress, as you said. I mean, they can't meet redemptions or don't want to meet redemptions. The marks on the private, the marks they put on these private loans and private equity are just collapsing like, a deck of cards. There was one that went from 100 cents on the dollar at the end of February to 0 cents on the dollar at the end of March with no change in the company. How can you change a valuation so dramatically when nothing has changed in the company? It's because the marks on I'm talking about private companies. I'm not talking about the publicly traded BDCs, which have more visibility and more, I think, credibility. But in the private, they're basically, a lot of them are just sort of making up the numbers.
So before we move on to the metals and commodities, ultimately, what are the biggest risks and opportunities for you for this year? We'll talk about both risks and opportunities.
I think there's a couple of risks. One risk we've already talked about. That's the private credit market, which is highly distorted and dependent upon leverage. So rising rates or another deteriorating economy can have oversized impact. So that's definitely one. I think the other major risk, and this is sort of known, but the other major risk is if the war, and I'm using war as a shorthand, because it hasn't actually been declared yet. But if the war in Iran lasts, if we have a bad result there from the US point of view, meaning it extends, it gets deeper, and it lasts longer. And scenarios that one could play out, Iran destroying the desalination plants in the Middle East and the Gulf. That would be devastating for a desert region that depends on desalination plants for their potable water. Remember, when the Strait of Hormuz is closed, it's not just oil. Everybody talks about oil. It's also natural gas. Not one natural gas shipment has passed through the strait since the bombing started. But it also affects fertilizer, nitrogen, potassium. They all come through a lot of that comes through the strait. And so that will have a significant impact on fertilizer. Nitrogen prices have already gone through the roof, but it will have a significant impact on fertilizer just as we are approaching, Australia's second planting season and the Northern Hemisphere's primary planting season. And higher in the US, in North America generally, we are less exposed to higher oil because, of course, the US, even though it is an importer, it's also an exporter. So the US produces all of its own energy if it wanted to. It exports some and it imports some. Canada equally. In terms of fertilizer, obviously, but Canada's a huge producer of potassium and potash. So the US is less exposed. Of course, it still will be affected by what goes on in the rest of the world. The rest of the world's economy slowing, buying less from the US hurts the US economy, obviously. But higher prices, even if the US can get all of the fertilizer it wants, but at higher prices, that means individual farmers make individual decisions on how much they can afford. That means the likelihood is that, they'll use less fertilizer. And the crop yields, 6 months from now will be undoubtedly softer. I'll use the word soft, which is a nice neutral word, but they'll be softer than maybe anticipated. And that means, I'm not suggesting we're going to have famine in the United States, but that we might have famine in other countries, but we're going to see higher prices. And so I think, so that's one scenario. Another scenario is, what just happened this morning? The news this morning that an F-15 had gone down, and there's two crewmen missing. One can easily imagine scenarios, but are horrible, not only for those people and their families but if Iran captures those two people and uses them as hostages. We remember 1979, the first Iran hostage situation. So that could just make the war deeper, longer, with more devastating results.
Okay, so bottom line, the war isn't ending anytime soon. Well,
I
this
didn't
is
say that, David. I don't know. I'm just saying there's a whole diverse range of outcomes. But the worst outcomes, which are reasonable, they're not just, better than zero probability. They are possible scenarios, has not been priced in and will be devastating for the economy.
This chart speaks to what you were talking about earlier, which is rising agricultural prices. This is COW, COW, the iShares Global Agriculture Index ETF. Interestingly, it's been rising before the Iran war broke out, and so afterward it's actually just stabilized and gone up slightly. If you look at something like corn futures, for example, which I had on my screen earlier, it actually hasn't gone up anywhere. Of course, there are other agricultural products that are affected by higher fertilizer, but the notion that food prices will be spiking soon. How realistic is that assessment, do you think?
Well, I'm not saying they're going to spike soon. I'm just saying that if the war continues and fertilizer prices continue to move up and there are shortages of fertilizer, then there is a risk, particularly to commodities such as wheat, there's a risk to those prices. Think after the Russian invasion of Ukraine, wheat prices went up 75% because of the lack of fertilizer, as well as wheat coming from Russia and Ukraine, of course.
Okay. Are you in your portfolios, any of your portfolios, pivoting towards energy and oil stocks?
Gosh, I hate to say it, but we're actually reducing our exposure to oil.
Interesting.
Yeah, well, it's interesting because, 3 months ago, 6 months ago, 12 months ago, I would be saying that I thought oil, and I'm not the only one saying it. Rosenzweig has been saying it, Rick Rule has been saying it, but oil was the most undervalued commodity out there. But the interesting thing is that the oil stocks, generally, in my view, were not as inexpensive as you would have expected based on the extreme undervaluation of the oil price itself. And one of the reasons for that was that because oil is so hated, because the narrative is that we're going to stop using fossil fuels altogether in 10 years. I mean, in 10 years. And, a lot of big institutions will not invest in oil stocks, et cetera, because they're so hated. The oil companies did the rational thing. Instead of taking millions and billions of dollars and investing, looking for new oil projects, they bought back stock and increased their dividend. So by buying back stock and increasing their dividend, even at the cost of their primary business, they made the stocks more attractive to investors. And so the stocks were moving up for 6 months before the war. They moved up a lot in the month before the war in anticipation, of course, and they've moved up even further since the oil price spiked. But they were moving up, for months before that. And to me, there was a bit of a disconnect between the extreme undervaluation of oil and the prices of the oil and gas stocks. So we have actually been selling after this big spike. We still hold some, but I've been selling.
Just so I understand this correctly, you're not selling because you think oil is about to collapse anytime soon because the Strait of Hormuz is going to be open tomorrow. That's not what you're saying. You're selling because valuations don't make sense anymore. So they're different things.
No, absolutely. And everything we do is not based, I mean, this, if you're an investor, you're not buying or selling things based on your own prediction. You're looking at the risk and reward, trying to assess them from where we are now. So from where we are now and where we have been for the last 2 weeks, there is a risk that the war continues. We've already talked about that, and that oil perhaps spikes even more. There's also a risk, if you want to call it a risk, that the war ends, and when the war ends, the price of oil drops. If the price of oil, even if it doesn't go back to 60, let's just say it goes back to 75. If the price of oil goes back to $75 a barrel, the war's ended, it's back, Strait is open, oil's at 75, the oil stocks will fall sharply. So looking at it at the risk and reward, looking at the valuation, we decided to sell.
So basically, you've taken profits on some of your oil positions. And so how are you reinvesting those profits?
Yeah, and let me just be clear. If we get the scenario I just talked about, the end of a war, straight open, oil price down, I will be looking to get back into oil because I still think on a long-term fundamental basis, it's the most undervalued of all the commodities. Well, we're certainly increasing the gold exposure. There are some very good gold stocks. Copper's come off a lot. The copper stocks have fallen quite a bit, so there's some good exposure there. Primarily, and we're also outside of the resources or outside of the commodities, we're buying agricultural commodities in various ways, not the commodities themselves like wheat or corn or anything, but, land companies, fertilizer companies, and so on. We're also buying global markets. The broad markets, global stock markets, as we've talked about before, I think last year were at their lowest ever relative value to the US. So the US has been the dominant market in the world for the last 15 years. The bull market's been going on longer, but for the last 15 years, they have been the dominant global stock market. And the divergence in valuation, in performance between the global or between the foreign, I should say, the foreign international markets and the US has been the widest ever. Now, last year, the global markets, global includes the US, the international markets, the foreign markets, outperformed the US by almost 2-1. This year, they're continuing that relative outperformance. Even though most of them are down, they're still outperforming the US. And I think that outperformance is going to continue for the next several years. So we are definitely looking, and with the markets all down because of the Iran situation and the oil price, we are looking for opportunities in foreign markets.
I know you're still getting questions from people that you know and perhaps clients about why gold isn't responding yet to, the Iran situation. And this is something I've been talking about since the beginning of March, but let's address this from a perhaps different angle here. Let me pull up the price of gold and let's see what it's been actually responding to, if anything. First of all metals have been moving, not all metals, but copper, silver, and gold, these three at least, and to a certain extent, palladium and platinum, they've all kind of been moving together in the last 2 months. Gold has been moving alongside stocks, prompting a lot of mainstream media to be writing about how gold is no longer a safe haven asset. Look at how well correlated gold and the S&P 500 is. Now, I'm going to pull up something interesting here. The relationship between gold and the US 10-year is erratic over the long term, but over the last 3 months, it's been pretty consistently inverse to the T almost. It just looks like gold is really responding to the bond market here. And it's not even responding to DXY because there have been several periods in the last month when the DXY and gold moved together. But it looks like whenever bond yields spike, gold goes down and vice versa. What do you think of this?
Yeah, no, absolutely. And you're quite correct. I mean, I just read yesterday, in fact, by I won't name him, but a well-respected, well-informed commentator saying, I'm getting lots of questions on why gold hasn't gone up in response to the war, and people are puzzled. I am too. But the truth is that if you look historically, gold typically goes up ahead of geopolitical events and it drops after the event has started. That's a normal pattern unless the event comes completely out of the blue, like 9/11, for example. But the Russian invasion of Ukraine, to take a most recent example, gold moved up ahead of the invasion. And then in the 6 weeks after the invasion, it gave back all of those gains. And we saw that with Iran. That's a normal pattern. It's buy on the rumor, sell on the news is one.
Wait a minute. Who's doing the buying? I mean, I can't imagine that the regular retail investor knows ahead of time if there's going to be a major war. Is it central banks? Is it governments who may have some inside knowledge?
No. Yeah. No, if you look at take Russian invasion of Ukraine. Yeah. I mean, for 6 weeks, the tanks and the troops were massing on the border of Ukraine. Mm-hmm. And there was debate in papers and, Substack and everything. Are they going to invade or aren't they going to invade? It wasn't clear they were. I myself thought they wouldn't. But I mean, the signs that they might were there as the tanks were on the border. And this time, I mean, we can hardly say the bombing was a surprise. It was a surprise that it took place in daylight, but it wasn't a surprise that it happened. So I think gold just moves up ahead on all of the speculation. So it's buy the rumor, sell the news. But the other thing that's very important, there's two other important aspects to this, David. One is liquidity. Anytime you have a geopolitical event, you typically get some kind of liquidity crisis, whether it's global or regional. And in this case, you've certainly had a liquidity crisis in the Middle East. You look at Dubai, people wanting to leave Dubai, families, expats, maybe the expat stays, but he sends his family away and they've got gold stored. So gold was selling at a discount in Dubai as people just rushed to sell everything to move out. That's a typical sort of example. We are obviously a typical sort of case. And we obviously had Turkey sell. We know that now, nearly 60 tons, which is massive, by the way. To put it into perspective, that's 60 tons they sold in 2 weeks compared with what total central bank buying of 850, 860 last year. So to sell 60 in 2 weeks is very, very meaningful. And that's all part of the war because the war hurt the lira, so they sold their gold to defend the lira. And the third factor, I don't know if I explained that properly. The third factor, which is very significant, is there are considered two major safe haven assets. One is gold, and one, of course, is the dollar. And if you look at the dollar and gold since the beginning of February, you see it's almost, as you put it with the bonds, it's almost an inverse relationship. When the war seemed as though it was going well, the dollar started falling and gold started moving up. And when the converse happened, the dollar was moving up and gold was falling. So yeah, I don't see it as a great anomaly, frankly.
Have you been taking profits on your gold stocks like you have with your oil investments?
Well, we were taking profits and never as much as you want, of course. But we went into March, or went into actually February, with a reasonable amount of cash. I will say that. We started selling. Remember when you had the decline in October, and then a lot of people thought that was the end of the bull market? Now it just looks like a blip. It's almost erased from memory. But at the time, there's a lot of discussion about this is the top, the gold market's over. And when we had that recovery and move up in January and February, yeah, we were taking some profits. Again, never as much as you expect. The only things I've been selling since the bombing started, since we've had this, we had a big drop, as you recall. Then we had, which was basically Turkey. Then you had a good recovery for 2.5 weeks, a very good recovery. We were selling into very recovery because I simply didn't think the gold had fallen enough to wash out all of the weak holders. I'm being very selective in what I sell. I mean, I'm not selling Franco-Nevada or Wheaton or Agnico, but being very selective on companies that I thought had higher risk. So, for example, Barrick, with their project in Pakistan, people forget with the Iran situation, but Pakistan and Afghanistan are also at war. And there's a big security issue in the Balochistan, whatever it's called, province. So that seemed to me to be a good candidate to reduce, if not sell outright, depending on the client. If we're looking to reduce our exposure because gold may drop lower, that seemed a good candidate because of the Pakistan situation. And there's been some other things like that. But on balance, no, we haven't been. On balance, we've been doing more buying than selling.
And the gold companies are relatively insulated from the Strait of Hormuz, which is to say, their supply, if they're a producer, their output isn't being disrupted by the closure of that waterway, right?
The output is not being disrupted. I mean, we did also exit producers and explorers who were in that region, including East Africa, which is very close. But no, broadly speaking, their output is not affected. Of course, their costs will go up. And again, there's some sort of exaggeration there. I think you look at the cost of oil, which is the major input for gold mining companies. It's their number one cost input. But BMO, Bank of Montreal, did a study where they said that for every $10 increase in the price of oil, it adds $2 to a gold mining company's costs. So $40, that's about 9%, because it compounds, obviously. So 9% cost increase is meaningful. But when you're Agnico Eagle and your all-in sustaining cost last year was 1347, was it? Or 1327, 13. Let's just be conservative because I forget the exact number and say less than 1350, and you're selling your product at 4500. A 9% increase in costs is not devastating, right? It's not devastating. So I think we don't realize just how fortunate we've been for the last few years. While the price of gold has been moving up, costs have really stayed pretty stable. And the margins have expanded in an unprecedented level. Unprecedented. Because normally when the gold price moves up, the input costs move up. The cost of oil goes up, the commodity currencies, which is your second largest cost input, because that's everything local. You're a Canadian miner with a mine in Australia. The Australian dollar affects what you have to pay your workers, what you have to pay for food, what you have to pay to build camps, etc. And so think back to 2011, gold was at 144. The Canadian dollar, the Australian dollar were trading at 25, 30% premiums to the dollar. This has been a completely different environment. And so a 9% increase in costs, even if oil goes to $200, what are we talking? We're talking about 25% increase in costs.
So,
yes, hurtful, but not devastating.
let's wrap up the discussion, and I just want to point out the holdings of your Pacific Gold Fund, and maybe correct me if these are out of date. This is dated December 31st, 2025. Top 3 stocks: Agnico Eagle, you just talked about, Pan American Silver, and Fortuna. Now, what are these companies doing differently that warrant this position? Yes.
Yeah, well, first of all, I need to say that we're not allowed to talk about what we are doing in the fund or will do in the fund.
Sure.
We can only refer to our last quarterly disclosures.
Sure. So maybe just
Agnico is clearly doing something different from most of the miners. They are without a shadow of doubt, the gold standard in gold mining companies. We talked about energy. Think about it. Agnico has hedged over 50% of its diesel consumption for this year at 49 cents per liter, right? So even the impact that I talked about earlier of 2% for every $10, for them, it's only half of that because they've already hedged over half their production. Pan American is... So I like Agnico because it's a great company, great jurisdiction, great pipeline, great mines, do what they say they're going to do, and great management and a depth of management. When I have a meeting with Agnico, it's not just me and the IR person. There's a team of 15 people, and every single one of them could be a CEO. Every single one of them is a star. Pan American, just a really super company, very, very conservative. They've got virtually no debt. The only debt, very financially strong. The only debt they have is debt they acquired when they took over Yamana, and that debt is under 2%. So if you've got debt at under 2%, you have to think long and hard if you really want to bother paying it off. So very strong balance sheet, good operators, very strong leverage to silver, even though silver production is actually way under 50% of their total revenue. Like last year before the Mag Silver acquisition, last year was something like 22% of our revenue came from silver. The Mag will increase that, of course, and then the Skarn deposit at the La Colorada mine will increase that even more. And of course, they have the Escobal, which is shut down at the moment, but they're in talks. The government is in talks with the local community about possibly reopening that. So they have they're extremely solid at the moment, but they also have additionally extreme leverage to the price of silver with 2 huge mines to come into production. And the third one was Fortuna. Fortuna, much the same. Very, very strong management, very conservative. Again, a team that does what they say they're going to do, which shouldn't be unusual, but unfortunately in this business is unusual. They're well diversified. They've got 4 different mines operating now, but they've got a good sort of pipeline of exploration potential, stakes in other companies, as well as just plain old exploration projects that they're looking at. Well diversified in terms of gold, silver, but also in terms of geography. They're in Mexico. Well, no producing in Mexico at the moment. So they're in Peru, Argentina, Ivory Coast, and one other I forget right now, sorry. But in West
Yes.
Africa and Latin America.
All right. And Adrian, let's wrap up here. Appreciate your time today. Tell us where we can follow you.
Yeah, well, the best place is adrianday.com, and that'll take you to our webpage on for money management.
Okay. Thank you so much. We'll put the link down below. Follow Adrian there and stay up to date with this channel by subscribing and following. And Adrian will be back soon. So stay up to date with Adrian in both places. Welcome back. We'll see you next time.
Thank you.
Thank you for watching. Don't forget to like and subscribe.